Glad you guys are here again. And for those of you who might be guests or are not as familiar with CCIM as a lot of the members in the room are, we are a global organization that is basically an education-based designation that is kind of a quasi-type master's in real estate. But we go towards brokerage, development, banking, insurance, any industry that touches real estate analytics is pretty much who our members are. And by gaining that designation, it's a kind of a gold standard, a platinum standard of knowledge and typically experience about what we do, who we are, and how we're able to look at problems and solve riddles. So that's kind of who we are. The Georgia chapter is more than 300 strong. It's one of the largest chapters in the country. We have several of the national directors for CCIM that are actually Georgia chapter members and have had some past presidents that we'll talk about a little bit later. But we are one of the most active and prolific chapters with just really great programming. And we've done a great job this year, we think, in terms of, with a lot of hard work from our directors, in upgrading the programming even further from what it has been, which has always been very, very good. But we have a lot of networking events, education type events, Luncheon learns. We even did Top Golf this year. We went to a film studio to learn about the film industry and how it's affecting the real estate platform. So we've done a lot of really cool stuff, and that platform is only going to get stronger next year under Kevin's leadership. So the bottom line is we're really glad you're here. The other thing are the sponsors. That's who really keeps us going. We have our annual sponsors that pretty much are the reason that we're able to be in this room today from a financial perspective, and I want to recognize them. So our chapter sponsors right now, we have four platinum sponsors. The Simpson Company, Marcus and Millichap, Kitchen Kelly Gaines, and Bull Realty. Then we have our silver sponsors, which are Adams Realtors, Build Right Construction, Commercial Experts, First Colony Financial Corp, National Property Inspections, Signature Bank of Georgia, Standard Landscape, Strategic Exchange Advisors, Stout, Kaiser, Madison, Peak, and Hendrick, and Excelligent. And then this year our table sponsors, which is very important. These are the folks in the room, so thank you again. Active Senior Concepts, CBRE, CBC Upchurch Realty, Cushman and Wakefield, First Colony Financial Corp again, Invest Atlanta, which is the economic development arm of Atlanta, which is great to have them here this year. JWB Realty, McLean and Merritt, MLC Properties, Signature Bank of Georgia, and SIOR of Georgia, which is one of our partners in crime in terms of the real estate groups that we partner with a great deal. In fact, this year we did a wonderful philanthropic Feed the Homeless project with them. So someone who's near and dear to my heart, and actually I'm an SR as well. So we're very happy to be such a partner with them. Then we have our half table sponsors, which are Ackerman and Company, Fidelity Bank, Parkside Partners, the Radco Companies, and Taylor and English. So thank you again for everyone for participating and being a part of the financial backbone of our group. This year we have new folks coming in as our officers, and we've gotten ahead of the curve. This year we actually have our officers in place. The incoming 2016 officers, and I'll ask them to stand again, Kevin Brangers, who will be our incoming president, Andrew Joyner, who is our president-elect, and then Richard Slayton, who is our secretary-treasurer. So thank you guys, and we're looking forward to another great year. This year we also did something that is unusual. We have named 2 endowed scholarships, and we provide these scholarships for folks that are, again, gaining their CCIM designation and or some sort of education platform. And this year we went ahead and did 2 endowed scholarships, which means they will have continued life for as long as we're around. And those 2 were done in the name of 2 members who are no longer with us, who were very instrumental in our chapter. One was Edward Walsh, which that's the Edward Walsh Memorial Scholarship. He was our 1997 chapter president. And then Kevin McBride Memorial Scholarship. Kevin was a gentleman, a very big gentleman that we lost last year at a very young age, who was very instrumental with our chapter, with our finances, and other parts of our organization that deal with our financials. And it was a big loss to lose Kevin. And this year, not to put us on a complete bummer note, we'll get through this one though, Alon Price, we lost him this year, which is a very sudden loss, died in his sleep at age 43, and he was one of our directors. So a very sad moment, but his family at the eulogy, which we all attended, talked about how important CCIM was to him, and was a very big part of his life that was even acknowledged at his service. So it meant a lot to hear that. This year we're going to do something a little different. I wanted to do something where we recognize a member who is incredibly important to the history and why we're all here and how this has happened. We've not done this before. This will be the first year that we're going to award what's called the President's Award. And we're going to do this for this time forward, I'm hopeful of, if the directors all agree to do that in the future. But this year it goes to a gentleman who I have depended on greatly over the past year, and all the directors have done that over the past many years. He has his own company. He's not aware of this award, or at least he's not supposed to be if his people didn't tell him. But he has his own firm that does a lot of business. If you drive up north, you're going to see signs everywhere. He's incredibly community involved. He also served as the 2011 National President of CCIM, which has more than 15,000 members. That's a very big job, traveling the globe, expressing interest and trying to be the ambassador, which this guy, it could not be a bigger ambassador and gentleman of anything he touches. But this year the President's Award goes to Mr. Frank Simpson. Frank. So as a token of our appreciation, we got you basically kryptonite if you see this award. It's huge. And Kevin will help me award it to him. But this is, again, for incredible service, incredible dedication, and even though he's been all these big offices, he still daily is involved in CCIM, and that means a lot. So thank you, Frank.
Thank you. I appreciate it. Very much.
So the other thing I want to do, the bottom line, I could not have done what we've done this year without the directors, our current chapter directors. If they will please stand and be recognized. Thank you very, very much. We have a lot of work that we've done. It's been a very rewarding year with a lot of success, but a lot of work still to be done next year by the new officers, so we're excited for them. I also want to say a very special thank you to someone who has basically made everything possible in terms of the day-to-day, and we'll call it minutia because there is a lot of minutia running an organization like this, and that's Katie Centel, our chapter administrator. Katie, if you'll stand up. And Katie has actually announced her retirement with us, which she did not know. I was going to tell everybody that in the room. But very expected. She's growing into brokerage, which we're very excited about. She's also working on her CCIM designation, which we're super excited about. I mean, she's going to be around a while. But we're also going to miss her dearly. And this year has been a phenomenal year and many years of service being culminated in, again, a growth moment for Katie. So thank you. So now we'll get to the heart of our moment. This is the moment where we introduce our keynote speaker, which is Dr. Donald Radachak. And Dr. Radachak, most of you know him. He's obviously not from Georgia, but he is in the Georgia area, has been connected with Georgia State for many, many years. He has been a world-renowned economist, has been on every show you can imagine and pretty much every magazine you can imagine in terms of his opinions, his theories, and his thoughts on where the economy is, where it's been going. He's been relied on by the federal government, our state governments, still is a major go-to for any type of economic questioning or theories and answers that need to be predicted and analyzed. And we're just very fortunate to have him not just here to speak, but as part of our Georgia community. So that means a great deal to have him here. So Dr. Radachak, welcome.
Okay. Excuse me. I'm pleased to be here. I know that when I approached and I saw that table lining out there in front of that one door. I said, well, it's probably a small crowd. I didn't realize you opened up the other area here. And I know some of you have heard me before. And if you are still mad at my forecast about the Atlanta economy 10 years ago, get over it. You know. All right. No, you may not. I don't even think I was wrong. Remember, I used to write a column for the Atlanta Journal-Constitution, and my last column, before I got a problem with the editor, my last column was actually about, no, it is not excess pricing in the housing market. It is a bubble. And a bubble is not just the problem with the asset itself. It's the problem with the financing of the asset. And therefore, we'll not only have a real estate downturn, we will have a financial downturn. That was the last column I wrote. That was in 2005. Took it 2 more years to be true, but, and by the way, I was amazed. I wrote the column, and then in 2006, housing prices went up another 10%. And I was sitting there, what's going on with you guys? Don't you read? But anyway, it did happen. It just took a little longer to happen. All right. I'm here today to talk about what's going on. First of all, I'm not going to worry about the global economy. The Federal Reserve worried about that. That was a mistake. They shouldn't have done that. Remember, they were rumored to raise interest rates in September, and then they came out with a statement saying, well, uncertainty about the global economy. Remember when China devalued the yuan by 3%? By the way, China didn't devalue any further, and the yuan in the last month has gone up by 1%, although Trump probably hadn't figured that one out either. You remember, if you saw the debate, and I'm not criticizing anyone in particular unless they say stupid things. But, and knowing Trump, he'll come down here and criticize me. But nevertheless, he argued about the Pacific Trade Agreement, which was negotiated because we were afraid that China was getting too much economic power in the region, and we wanted to put our stamp on the region before they did. And Trump said, "Oh, it's something that doesn't discuss the valuations of the currency." Anyway, it was about China, but China wasn't a part of it. China was the reason why we negotiated it, which a lot of people still don't understand, including Hillary. But nevertheless, that's now I've hit a couple of the people. I'll stop. They'll make fools of themselves several times before the election, so I don't need to help that. All right, enough of that. What's going on with this economy? Actually, good news, bad news. People say, "Hey, you have all good news," and I'll get to real estate because right now, I will get to it because right now, real estate is really in a sweet spot, and real estate will never stay in a sweet spot for any length of time. Okay, and you all know that, but you're hoping that what you got right now is going to stay for the next 10 years. You know it won't, but we'll get to it. All right, enough of that. What's going on, not globally, with the U.S. economy? What's happening with the U.S. economy? Actually, I just wrote a report, and there are 3 negatives I'm looking at the present time. Negative number 1, and I will talk that it has a positive side to it, but negative number 1 is there is an industry in the United States currently in recession. It's called the petroleum exploration industry. Drilling rigs are down 1,152 from a year ago. We are now running less than 700 rigs. So we basically have reduced our activity in this industry by about 70%. And we're starting to see the effects. I was in Houston a month ago, and I talked to them. I said, at the end of last year, Texas employment was growing 4%. At the end of June, Texas employment was growing 2.3% from the year before. Now, if you do quick math calculations, that will more or less tell you that in that first 6 months, they were at a run rate of somewhat a little bit over 1%. Right now, Texas employment is basically growing at zero. Now, I just picked Texas because people say, oh, it's a diversified state, oil doesn't matter. Oh, well, I wonder what else is drawing it down then, if oil doesn't matter. And by the way, they have not seen the financial impact from it yet. All of those wells are used on collateralized loans, and they're priced once a year. And they're priced based upon engineering methodologies. And they priced it last year at $86 a barrel. They're going to have to price that same land, that same lease that's supporting their loans, at something on the order of $44, $45 a barrel. Now, just think what that does to the value of the loan and what banks are going to do, because they're going to walk in and say, I need more equity. And guess what? This is an industry that doesn't have more equity to give. Some of the big guys do, but a lot of the small guys don't. So there's going to be some financial fallout, too. They're just starting to see that. All right. That's the bad news. We've lost about 110,000 jobs in that industry in the last year. The good news is the rate of decline is slowing on the exploration side, but I just gave you the bad news. The financial side is just starting to notice they got a problem. And therefore, we're going to have weakness in at least 6 states. You know, Alaska, Colorado, North Dakota, New Mexico, Texas, and Oklahoma certainly are all going to be problem areas as a result of what's going on there. Okay, enough of that. By the way, California is truly diversified now. Remember, California used to be the number 2 producer of oil in the country. Now it's, I think, number 5. North Dakota certainly has taken over. Louisiana has taken over. Texas has always been number 1. And I don't know where Colorado is, but whatever. Enough of that. So that's a problem area, and it's dragging down parts of the economy. Problem area number 2. In the last year, the dollar has appreciated 12.5% against 20 major currencies in the world. Now, some currencies, like Latin America, it's appreciated by 35 to 40%. In other places, like, by the way, Japan and China, remember, the appreciation against China is only a couple percent, and the appreciation in Japan is only about 7.5%. So actually, Europe is closer to 20% when you take a look at the differentials. Europe is one of the bigger devaluation areas. I don't know why we keep yelling about China and that they're competitive devaluations. That was a false discussion there. All right, enough of that. The point of that is, you raise your price 12.5%, you're going to get a response. You're going to have trouble selling some of your product. Okay? Especially if you raise your price 12.5% against the rest of the world. So you're 12.5% higher than you were a year ago. I usually something like 6 or 7%. I argue we will find ways to handle that. I usually estimate that the threshold that significantly changes trade flows is about 10%, and we are seeing the change in trade flows. I've estimated already that probably $25 billion of auto assembly and product has been lost because of the increase in the dollar. Now, we haven't noticed it because basically auto sales have risen. So actually the domestic auto industry is as strong as it's ever been, but it's losing share. Okay? The electronics industry is down $35 billion. The pharmaceutical production is down $30 billion. Those are the big areas where we've seen the impacts taking place. What does this mean? This means that the activity in these industries are definitely slowing down. And in fact, in August and September, the manufacturing in the United States, only 1/3 of manufacturing sectors in the United States increased their hiring. Well, you get numbers like that when a sector is in recession. All right. Now, the good news is in October, it popped back up to 51%. So that it does appear we're shaking off some of that sluggishness caused by the strong dollar. Although, of course, when the employment report came out and everyone then made the assumption, which I'll talk about, that the Federal Reserve will raise rates in December, the dollar rallied another 2%. So we haven't yet seen the impact of that latest 2% rally. We probably will see manufacturing dipping back below the 50% higher level in the next month or two. Okay, so that's the second problem. Problem number 3. So we got three problems. Let me see. The first is the oil. The second is the third. First half of the year, we were accumulating an awful lot of inventory. Now, some of it we're accumulating because we're overproducing. The reason why we have oil exploration in recession is that the world is overproducing oil. We're producing about 2 million barrels a day more globally than the global economy is absorbing. Well, where's the oil going? It's going into inventory. Do people want to hold that inventory? Now, as it turns out, at the present time, they mostly want to. And the reason for that is the futures prices, because the people in the oil industry are still believing this is a temporary event caused by a shift in Saudi Arabian activity, and that they'll shift back now that they're running deficits and they're actually selling U.S. bonds and liquidating some of their portfolio to maintain their budgets. And the presumption as well they'll shift back fairly soon. That's probably wrong. The OPEC is saying that they're winning this battle against the U.S. shale producers. And they like winning, and they're willing to take a loss. And by the way, Saudi Arabia knows that while they're hurting, guess who's hurting even more? A country called Iran, who is not their friend. So they're not that unhappy that Iran is struggling even more than Saudi Arabia is under the current pricing regime. So the big issue here is we're still overproducing. We have to absorb that oil. We are absorbing the oil because the industry keeps thinking it's going to be temporary. And that means futures prices are up. Right now, the gap is about $6.50. Costs about $4 under current financing and storage to hold a barrel of oil for a year. The $6.50 is the price a year out. So you can buy oil today, sell it today for a year hence delivery, and make $2 on the oil. Now, it's not a huge amount, but it's a guaranteed amount. And therefore, people are holding about 120 million more barrels of oil than they normally would. In addition, by the way, the people who've been drilling, when they find some sort of marginal wells, they're not fracking them. They're not finishing the well. We have something like 6,000 wells right now that are ready to be fracked. But they're not going to, that's a costly event. And if you only have an ordinary well, why spend that much to bring it on? So we actually have inventory in the ground that could be delivered within a month or two. So there's a lot of inventory sitting around, which should, by the way, tell you that perhaps oil prices still will have some downward pressures, although the worst of it's probably over. Okay. Anyway, we accumulated that inventory. We also had some good feelings. I think a lot of forecasts at the beginning of the year was that this economy would grow more than 3% this year. And so we built up inventory in the first half of the year in anticipation of good activity. Now you recognize the third quarter came in at, well, the first quarter we had bad weather. Then the third quarter came in at 1.5% because we finally decided we have too much inventory. And we're starting to work it down. We probably have 2% of GDP inventory overhang. We had 2.5%. We got rid of 0.5% of it, but we have to get rid of more of it. And until we get rid of the excess inventory, we're going to have less than normal growth rates. Now, having said that, we actually took 1.5 percentage points out of growth in the third quarter because we shifted our inventory investments. We'll probably only take 0.5% out in the fourth quarter and then another 0.5%. And then at that point, you will be at a level that the next quarter you'd be back to balance. So in spring you'd be back to balance. You wouldn't have to take any further out of inventory. So 1.5 in the third quarter drag, 0.5% in the fourth, another 0.5% in the first quarter, and then no further drag. And then, by the way, the third quarter you probably have to pop up because you'll be producing below what needs will have. So the second half of next year could be a reasonably strong year. But we still have to work through some of those inventories before that can happen. So those are the negatives. Now, as I said, the petroleum also has a positive. And, you know, I also gave a talk down in Florida, and I looked at their employment figures. The end of last year, their employment was up 3%. Now it's up 3.5%. Florida's a consumer state. Texas is a producer state. The good news is there are about 6 producer states and 44 consumer states. So yes, the Florida gains aren't that big, but there's a lot of them in a lot of states, including Georgia, by the way. We are a consumer state. So this is helping our economy. It's helping the Florida economy. It's helping most of the consumer economies. And overall, the presumption is it's going to be more help than hurt for the U.S. economy. But there is that hurt. Now, how much is it helping? Well, you take a look at the October employment report, hourly wages up 2.5%. CPI, what is it year over year? Well, if you're receiving Social Security, you know, it's 0 because you didn't get a raise, all right? 0. 2.5% increase in hourly wages, 0% increase in consumer costs. And that means 2.5% real growth in wages. We don't get 2.5% real growth in paychecks in healthy, strong economies. Sorry to tell some people who were bad-mouthing the current economy. It just produced 2.7 million jobs in the last year. That's not bad, you know, 2.7 million jobs. And the fact 2.5% real purchasing power in the pockets of the average worker. And by the way, we have 2% more workers. What does that mean? That means the household sector, excluding the tax changes, which aren't that large, the household sector right now has 4.5% more purchasing power. It doesn't mean they'll exert it. In fact, they're building up some of their savings. But it does mean they have the capacity to have a pretty good holiday season here. And we're sort of expecting we're going to have some of that. I started out before the October figures, which finally showed some upticks in earnings, that I thought that we would be about 0.5% behind this year on holiday growth than last year. Why? Because back to school wasn't that great. Halloween, which, by the way, is now an adult holiday. The costume industry had the largest rental of costumes in their history. Okay? Yeah, see, I get all kinds of minutiae out here. But basically, the third quarter was not good for retailing. And you're seeing some of the results, as the retailers are now announcing this week, on their earnings performances. It was not a good quarter. Back to school was not good. It wasn't terrible, but it wasn't good. And retailers usually look at back to school and then Halloween. Halloween is a very discretionary holiday, so it gives them an idea how much discretion there might be in the holiday season. It hadn't picked up yet, but the job outlook looks pretty solid. The earnings of the household sector look good. We should be able to meet last year's 4.1% growth in holiday sales. So, in fact, I just raised my numbers up to that in the last week. You might find some people who've been more pessimistic, they haven't yet worked through all the numbers to raise their estimates up. Now, having said that, remember, we still have some drag from inventory. We still had the recession and, of course, the latest pop in the value of the dollar will slow down things a little bit. The good news on all of that is that we're still going to generate a fair number of jobs. Now, probably the 271 of October was probably unusually strong, We're probably going to slow it down to something slightly under 200,000 a month. But basically, with the unemployment rate sitting at 5%, it's going to be kind of hard. Now, by the way, if people come up and say, "Oh, but how about all those people that aren't looking for work because they can't find it?" There is some truth in that, but the people can't find work with the same salaries of the job that they previously had. Why not? And I hate to tell what the truth is. The technology and knowledge necessary is passing them by. They're obsolete. Their training is obsolete. They need to go back to school. They need to be retrained. They need to be retooled or something. And they recognize that, and they don't want those lower wage jobs, so they're not even looking for work. It is going to take something other than a strong economy to get that participation rate back up. So anyway, that's an area, in fact, I just finished doing some work on at the present time. So anyway, that handles the participation rates. When people go, "Oh, but how about the hidden unemployment?" They're so hidden that they're not exerting any influence on the labor markets at the present time. So, all right, it's not good that we can't get those people back. But on the other hand, it's going to require retraining and other things for that to happen. It's not a strong economy is not enough for them to get back into the workforce. Okay, so the consumer is doing well, has the capacity to do well for some time to come. Now, no, I don't want to be too rosy. Remember, what made that 4.5%? 2% growth in payrolls. Maybe we can do something close to that next year. Probably not quite that good. Probably 1 3/4 or something in that nature. About 180,000 jobs a month instead of the 200,000 plus we've been doing. But it's still not bad. Pretty good numbers coming in on that. But the other part, the 2.5% real wages, that happened because gasoline prices were falling. Gasoline prices aren't going to fall forever. No, there's still probably one more down leg in that. We are going to see, even in Georgia, I predict that we will find gasoline stations, not in the center of town, but in other places, that'll be under $2. I know somebody says, "Oh, it's already there out in Duluth." Well, and I know it's 180 in South Carolina. Didn't you know the governor raised taxes on gasoline? Didn't anyone notice that bill passing the House? Giving you an idea, by the way, in October, state collections were up 4.8%. If you take away the increase in gasoline taxes, state collections were up 1%. Okay? Snuck that one over you, didn't they? Because the prices of gasoline were coming down. That was smart, by the way. I do once a year advise the governor, and I applauded his decision for that. And you might say, "Oh, applauded a tax increase." No, I applauded filling the potholes in the roads, which is what the tax increase helps finance. But anyway, okay. So that 2.5 won't continue, but it'll come down gradually. It'll probably come down to 2 to 1.5, and of course the payroll. So that 4.5% spending capacity will flow down to about 3% in the second half of next year. But remember, in the second half of next year, we'll have some industry picking up because we'll have finished our inventory accumulations. So we'll probably grow close to 3% next year. It'll be wiggling around, but it'll be close to 3% overall. This year we're going to be only 2.2 because remember we had a bad first quarter and then we had the inventory adjustment starting in the third quarter, so that slowed us down. But these are decent numbers, okay? By the way, the inflation rate, just to throw the end of these annualized things, the inflation rate right now, as I said, the CPI is 0. It's not going to stay 0. Again, gasoline prices are a big drag here. Those prices will stabilize at some point, probably in the spring. And at that point, You no longer have that drag upon prices. So what's happening to other prices? Well, if you use the CPI measure, the core inflation rate is running about 1.8%. If you're using another measure that the Fed does, it's running about 1.3. That's the number that you'll start to see. And next year, we'll probably have inflation in the 1.6 to 1.8 range. That's still very nice numbers. It's just not zero anymore in the inflation numbers. Now, what about interest rates? All right, first of all, the markets, as soon as they saw the employment report, put 25 basis points on the 2-year bond. 25 basis. Immediately, they repriced. They've already priced the December move in the bond market. The December move is already priced into the market. So that's not a question. In fact, since it's already priced in, let them do it and get that uncertainty out of the way. They're going to do it. It's going to be awful hard for them to explain why they did not do it in December. So we will see a quarter-point rate increase then. Okay, so the interesting question then is, what's the speed by which they will be raising rates? Will it be one and done? No. It's pretty clear that they're talking about a process leading to normalized rates, whatever that means. But normalized is clearly significantly higher than where we are at the present time. So what's the speed? Well, they're clearly not going to go in January and do it again. They're going to wait, and they could easily argue we want to see the effects, and 1 month is not long enough for the effects to happen. So your next move is probably going to be in June. And then the presidential campaign becomes in earnest, and the Fed doesn't like to be talked about during presidential campaigns. So they probably will lie low and not make the third move until December. Then in 2017, I think it's realistic, if the economy indeed in the second half of 2016 is growing 3% plus, it's realistic for them to move further in 2017 and probably come close to their forecast of their rates, which is, their forecast actually is about 1.25 percentage points a year. I'm not assuming they'll move that quickly, but I'm assuming they'll move about 1% in 2017. So rates definitely are going up. But, you knew that. Rates couldn't stay where they are. Okay. They're not going to be normalized until sometime late in 2018. And normal rates right now on the short rate is probably 3.5. On the long rate, that's probably 4.5. So those are the numbers you should be looking at in 2018. Okay, with relatively gradual moves up until you get to that. All right. Now, somebody asked me questions. Do we have bubbles in the economy? Is there a bubble in real estate? Not yet. And by the way, real estate is crazy. You shouldn't talk about real estate right now. You got to talk about each of the products. Okay? First of all, single-family housing? No, it's underdone. It's underdone. We need more single-family housing. Why aren't we building more? Well, because, of course, that was the place where the financial institutions got bruised. And so they're very cautious. Remember in 2005, if you could show that you had any income, you got a mortgage. Today, you have to show that you don't have significant loans. Well, guess what? The potential first-time home buyer has a big student loan. Now, that's keeping them from getting mortgages. I talked to a doctor at Emory, and she told me, she heard I was in college. Oh, that's great. Is it true that current conditions could continue through 2017? And I said, yeah. I mean, it's likely. It's a good guess. And so then she said, well, that's great. And I said, why is that great? Because she has a six-figure income. She is a doctor at Emory Hospital, which is a relatively stable position. Okay? This would be a slam dunk person you would give a loan to. But she has $200,000 in medical medical student loans. Can't get a mortgage. There is nobody in this town that will give her a mortgage at this time. 2017 is when she can pay down her debts enough that a banker has told her, come back when your debts are that, and that's when she'll be. There's a lot of people like that, potential first-time home buyers. What are they doing? Actually, for 5 years, they were in their parents' basements. That's what they were doing. We had an unusually low number of household formations. Demographics were telling us, well, given the population profile and all that, households should be growing about 1.1 to 1.2 million. In fact, for 5 years, they were growing under 700,000 a year. That's changed. In fact, in the last 12 months, household formations have moved from that very low level. We're now running at 1.4 million, which is no great surprise. I mean, you know, the parents' basement gets really dreary. So it's no great surprise that they're now forming at a faster rate than demographics would predict, because you had this big backlog. And this will occur for several more years. Where are they going? Not single detached homes. Can't get the financing. Going into rental properties. So what do you have? You have the lowest vacancy rates in apartments in 4 decades. Rental rates are rising 5% a year. It now costs more to rent the same square footage. If you could get the mortgage, you could buy a house for it. Okay? Not in my neighborhood. I live in town. Expensive place. But on average, I've been there a long time, so I like that it's an expensive place. But nevertheless, okay. So anyway, and the good news is that the vacancy rates are very low. The yields on those properties have never been better. The bad news is those properties are easily bankable. Okay? Therefore, you know, I had some people say, oh, I heard that we had 10,000 permits in apartments. No, we've had 16,000 apartment permits so far this year in the Atlanta metropolitan area. By the way, if you've never heard a number that high for Atlanta, you're right. We never have permitted that many apartments in Atlanta. By the way, this is true nationwide. We got a heck of a lot of apartments coming out of the ground in Atlanta and everywhere else. No problem right now. Vacancy rates down 4%, 4 decades. Rental rates up 5%. No problem now. But remember, 2017, that person and a lot of persons like that are leaving the rentals and going to the single detached. Okay? By the way, that's good for the economy. Per square footage, the single detached is bigger economic value. Okay? So don't look at the economy slugging down, but do look at apartments maybe 12 to 18 months from now not being as good as they are now. And if you're into apartment areas, think about finding an insurance company that's crazy enough to buy it. Because, of course, they're not crazy, actually. I mean, because what's their alternative? Government bonds? So, and they have guarantees on the policies they've written. So how are they going to make their guarantees? They're going to have rental properties. Okay? So, anyway, yeah, you might have a bubble blooming there in the apartment area. Single detached, don't worry about it. We're going to run several more years. The prices are rising about 5%. We're seeing slow growth in the single family detached. It looks like a very healthy market at the present time. All right, some realtors are arguing we don't have enough product, and I'm sure in some parts that's correct, and in some price points that's also correct. But quite frankly, it looks like a very healthy market that can sustain for several more years at least. So I'm not worried about the single family detached. How about office space? Well, look at the Atlanta area. Second quarter, net absorption up 1 million. Third quarter, all right, it was only up 600,000, but usually summer isn't the big boom time anyway. But the interesting part, how much is being delivered? Where's the supply? Okay? Isn't any significant supply on the horizon until the second half of next year. So even at a pace of 500,000, by the way, we're going to be generating employment growth that's going to require more than that per quarter. So what's going to happen? You're going to see the rises coming. And all right. So the office space is going to do fairly well. I mean, take a look. Vacancy rates are coming down. All right, 16%, well, 15.9, probably 15.5 now. And there are a couple. I mean, downtown, Georgia State can't take every building. So you got a problem in downtown. The Northeast, a little bit of a problem in the Atlanta area, but as a rule, not a lot of a problem. Okay? Buckhead certainly doesn't have a problem at the present time. Well, it has a retail problem, but it doesn't have an office building problem. Okay? So I don't see that as being a problem until 17 or 18. You know, when the banks finally say, yeah, we're ready to do all this financing for them, that'll be the time. When you find the banks still making it difficult for you to get the financing, that's good. Remember, that's good news. That means that the supply won't grow that fast. Okay? When the banks say, oh, geez, please come. Okay? When all your platinum sponsors are banks, worry. Then you got a problem. All right. Yeah, I don't see a problem there. Warehousing, we're building a fair amount, but the rents are still going up. There is vacant space there, but and you're getting an imbalance now. See, first of all, an unusual thing is happening globally. There's no growth in global trade. Now, a lot of it's because China's trade is collapsing, but in general, there's no growth in global trade. And as a result, traffic on the ports is not as strong as it ought to be, and we would normally expect. That's going to change. It looks like China may be in the process of stabilizing. You know, people have said this for 12 months, and they've been wrong. But, you know, sometime it's going to be a correct statement. And I haven't said it before, so there's a possibility that I may be the first one to say it correctly. But it looks like China is stabilizing. And therefore, their trade figures, although the last months were horrendous, an 18% reduction in imports, a 7% reduction in exports for the number 2 economy in the world. Wow. And you're seeing it on shipping values and all this kind of stuff. Everything in that area is collapsing. But East Coast, that Panama Canal, all right, that widening, you might say, well, what's the big deal? Right now, the Panama Canal can only take 14 wide containers. After the widening, they can take 18 wide containers. And I know this is difficult to understand, but 18 wide is double the capacity of the 14 wides. Don't ask me how that works, but you can sit down there and count the containers. It's true. And what does that mean? If your product depends upon shipping costs and you're delivering to the east, it goes through the canal and comes to the eastern ports. The eastern ports will grow 3 times as fast as the western ports. Right now, the western ports have been growing twice as fast as the eastern ports. So you hear that, Savannah? Anyway, so that's going to be the shift. And that will change where warehousing ought to be built. And it will be positive for our state. Okay? So warehousing is an interesting question as to what's going on there. But at the present time, with the rents still going up, you have to think that things will be working fairly well there. So, and I did apartments, single detached, I did office space. Oh, retail. We might build 1 or 2 shopping malls somewhere. The shopping mall era is decaying. It's not as serious yet here as it is in China. Do you realize that something like 70% of all the growth in retailing in China is done on internet basis now? 70% of all the retail growth in China. People don't go to stores. And that's happening. I mean, well, I just said holiday growth could be 4%. 4% total retail. You know what the package estimates are? Therefore, the internet part of that, the growth should be 12%. 2 to 2.5 times the growth of all retailing is going to internet traffic. What does that say about standalone stores? Okay, you don't need a lot of them. I mean, you need the warehouses, by the way, but you don't need the stores. And you do need grocery stores and you do need drug stores, and therefore that type of retailing will work. I mean, I realize with Uber and all, you can have someone deliver your groceries too, but that's getting expensive. I mean, that's really Cadillac grocery shopping. It's not the standard. People are still going to drive to grocery stores, and they're still going to pick up, well, maybe they're not going to always pick up their prescriptions, but they will probably want to get out every once in a while, and a drugstore is a good place to go every once in a while. So, but the other retailing, it's getting more problematical. So we'll have to watch. But my figures show that the big boxes are growing too fast. They're not growing fast, but they're growing too fast, meaning that the demand is going away from them. And the department stores, we know the demand is going away from them. That's been happening for the last 2 years. So retailing could be interesting. I'd be a little bit more cautious there if I had to figure out where. The apartments in 12 to 18 months, retailing anytime. Just watch what you're doing there. Okay, questions? Anybody want to ask me anything? I'm ready. He's got a question over here. Stand up and yell.
Do you see any risk from student loan debt to the economy as a whole?
Well, we already seen some risk. They're not getting into single detached homes. Yeah, you're going to see a significant change. What I'm seeing with the millennials, which is where you have the heavy student loans, is you're seeing them basically buying a lot of electronics, not buying that much on the apparel side, but and of course delaying. They have already delayed household formations. They're now starting to catch up, and delaying their remodeling and that kind of stuff, and furniture purchases and things of that nature. That's what you're seeing as a result of the heavy debt. They're being restrained. Although I'm trying to work through an anomaly at the present time, because all my statistics say that the household sector has increased purchasing power capacity and therefore should not only be spending more but also saving more, because the capacity is growing much faster than the increase in savings, in spending. Okay, so all of that, I think, and yet, for the first time, this is going to be the first year since the economic crisis that credit card debt is going to be growing faster than personal income. And so scratch your head. Why are credit card debt growing so fast? Is it that people feel good and they're buying that refrigerator and things like that, and they're putting it on the credit card and paying over time, or that would be a positive thing, or are there households that are stressed? And I've come to the weird conclusion that it's both. That we have some people who are, in fact, they're moving up, they're finally making those household formation type purchases, and that's some of the debt. And then there are a lot of people right on the edge, and that people on the edge are growing in number and they're stressed. And this is part of the problem we're having with the wealthy and and the people who've been passed by. It looks like we have more wealthy people and more people passed by in our economy. And so that's what we're seeing in the credit cards. So that wasn't a good answer to your millennial-related question, but are you a millennial? All right. See, hey, how many student loans? All right, next question over there.
Where could you see the U.S. Treasury 10-year going by 2020?
By 2020. Oh, geez, I had it to 2018. Now you want me to 2020. Is the Fed going to screw it or not? Was it going to really make bad mistakes or not? The bad mistake, in my opinion, is not to get normalized. That you need to. If they don't get normalized, then what will happen, I believe, is that we will start to see pressures building in the labor market. The fact that we finally have seen earnings rise might be the first sign that it's hard to find the type of labor that you want and you're willing to pay up to get it from some other person. Okay? That's the beginning of, we've always been talking about deflationary spiral. That's the beginning of an inflationary spiral. Now, people say, we're at zero. Why worry? Spirals are spirals. They can start at any point. Okay? And inflation, you could control it. And that's why they want the 2% target and all this kind of stuff. But if they're too slow, and if those earnings go, in Germany right now, wages are already growing about 3.5%. Germany already is starting. They can't see the spiral because they're in the euro and they're getting the benefit of a weak euro because the rest of Europe is in bad shape. Okay? But the Germans are actually having that kind of a problem right now. We could do that. And therefore, in 2018 or 19, we could be staring at 5% wage increases. And then all of a sudden, you've got an inflation problem. And then that 4.5% projection ain't going to hold. You could be 6 or 7. But at the present time, this is all controllable. But it's controllable if you have all of your weapons in place. And if we keep staying at zero interest rates, we won't have them all in place. Okay? That's why it actually makes sense for the Fed to raise rates. Even though it hurts your cap value, your cap values will go up. But remember, rents are still going up. The yields on the properties are still rising. It's just that you're not going to get dramatic increases in the market price of your asset as a result of that. Okay? Yes?
Proving the live feed from Savannah, we have a question from Savannah.
Oh, good.
Appropriate. Chuck Mitchell in Savannah has asked, do you want to commit to telling us which quarter the multifamily bubble will burst?
Well, in Savannah, all you need is one project, but that's not totally true. But what quarter? Well, it's 12 to 18 months. Say early 2017. That's, if I have to pick a number. And by the way, it doesn't have to burst. We could slow it down now. And it's healthy. It's a healthy economy. We could slow it down now. And therefore make everything work nicely. And we could be in the same position with the apartments that we are currently in single detached, which is a long, slowly developing, although in the apartments it'd be a constant, let's not grow anymore type of a position in apartments, and maybe we can keep it going. But I don't see that happening. I see too many apartments coming out of the ground.
We have time for one more question. Anybody else? Paul Ozzie.
Next recession, when it comes, whenever it comes, do you think it will be less severe, equal to, or more severe than what we just went through?
Again, it depends on what kind of weapons we have available. if we stayed at very low interest rates, it could probably be a fairly severe event. If you've already got interest rates normalized, then you have the ability to lower rates, and therefore to minimize the collateral damage. I mean, you know, the primary damage is going to be done wherever it is. It could be bad policy, it could be over enthusiasm, whatever. And that damage you got to get out of the picture. Okay, you got to get it out, but minimize the collateral damage. So if you overbuild housing, okay, housing's going to take a big hit. Prices are going to go down. I mean, we overdid it, and that should happen. But let's not have all the financial stuff go down. Let's give them some leeway with a cut in interest rates and things like that. And therefore, that would be an appropriate thing to do. I think we're going to be prepared before the next recession. Quite frankly, I don't see a recession through 2018. And it gets foggy beyond that because you are talking about policy too. And I don't know what kind of policy we're going to have. We can make predictions on the election, and then you have to make predictions on the policy decisions that are going to be made. The policy is going to change. Doesn't matter who you vote for, the policy is going to change. I mean, after all, you're either going to elect someone who was beaten by the person making current policy, and it's unlikely to just say, oh, he was right and I was wrong. Okay? That's not likely, even though the Republicans are trying to make it likely. Or you're going to get the Republicans, and they have a whole different viewpoint. Policy's going to change, but it'll take a year or two before they can really screw things up. Yeah, I had one last, the lady back there had a question, and let her give it.
Yes, what about the land? We did not cover what about the land?
Oh, yeah, land. Yeah. Well, the good news is, except for the Chinese, no one's making more land. And I mean, yeah, I'm in an in-town neighborhood, and there is no vacant space, but we had 12 new houses built. Well, how's that done? You know, obviously, you buy the property, bulldoze what's there, and build a new house on it. When people are willing to do that, you know, I mean, I'm talking about people are buying with the thing and all that. My neighborhood's selling at about $1.4 million an acre. That's what it comes down to, about $1.4 million an acre. Wow. Now, when you get way out there, here's the problem. People don't want to be out there. They want to be clustered. Now, you can make that work out, but you can't make it work the way we've been doing it. You can't just take out a few acres of farmland and throw a bunch of houses in and say, and I'm going to sell it. And I'll put up a sign and say, low 400s, and hope somebody doesn't realize that that's 400,000 rather than the mortgage per month. But anyway, that's not going to work anymore. You're going to have to do some community development. There's going to have to be some localized places. Atlanta actually is not doing badly in that. We have a half dozen localized zones that people go to. And that's what you're going to have to do. And I don't know how you do that when the structure is to bulldoze and build your homes. But that, you know, that's going to be a hard thing to do. Well-planned areas which will then have to be shared unless you have these super big developers, which is not what we usually do in Atlanta. It's going to be a hard thing to achieve. How do you get those little centers where people can walk and apartments on top of the retail and things of that nature? How do you do that in those far out properties? I don't see land going up that. People would rather do infill and bulldoze in at these very expensive costs per acre than go out there and take out another few acres of farm and build the communities there. So I think those land prices are going to be very slow to react, whereas our land price, oh my God, I mean, it's crazy. It really is. When I just told you a calculation $1.4 million an acre in my neighborhood, that was probably $800,000 at the beginning of the financial crisis. Okay? So if you want that land, it's very expensive. You want the stuff out there, you know, the $20,000 an acre, it's going to be $22,000 an acre in 5 years. Okay, thank you.
Thank you, Dr. Radachak, and thank you all again for coming today. It really means a lot to have everybody in the room. And while you were here, we created sunshine outside, so go outside and enjoy it. And please follow us on Twitter, LinkedIn, and be socially involved. Thanks a lot.